Imagine you just had a hard month slaving away at work. You get an email saying you've been paid $2,000, but your bank account only receives $1,456. Federal tax, state tax, Social Security, Medicare. You've just performed the modern ritual of handing a chunk of your labor over to invisible forces. These deductions act as the entry fee for living in a modern society. That vanished money builds roads, funds schools, ensures your sleep truck isn't infested with rats, and sends billion-dollar missiles to places you've never been. Once you accept the taxes, you deposit the rest into a bank. You hand a cashier your money, they count it, smile, and you walk out thinking it's sitting in a giant steel vault guarded by a dragon. The reality is entirely different. The weird part about currency is that it isn't actually real. A physical dollar bill has exactly as much inherent worth as a stick. The only difference is that society has collectively agreed the dollar bill is worth something. It is a social construct built entirely on trust. Because the financial system is a game built on trust and invisible rules, navigating it requires looking past the physical cash. Understanding the specific mechanics that move money behind the scenes is the only way to gain any control over where your labor actually goes. This diagram shows what happens to your deposit. When you drop off $1,000, the bank is really acting as a matchmaker. Through a system called fractional reserve banking, they keep a tiny fraction of your cash on hand. The vast majority, say $900, is instantly lent out to someone else looking to buy a house or a jet ski. The entire mechanism relies on one mathematical probability. Not everyone is going to show up on the exact same day asking to withdraw 100% of their money. Because when they do, like in 2008, the bank doesn't have the cash and the system collapses. To figure out who gets to borrow all that deposited money, lenders rely on a shadowy algorithm that tracks your financial past. It generates a 3-digit number between 300 and 850. This chart breaks down exactly how that algorithm grades you. The biggest factor is your payment history, whether you actually pay your bills before the late period. Then it checks your credit utilization, meaning how much of your available credit you are actively using, followed by the age of your accounts and the variety of loans you hold. Notice what's missing. Your income, your savings, your overall wealth, none of that is measured here. You can have zero debt and still have a terrible score. It is purely a metric of how statistically reliable and profitable you are to a lender. While banks are busy lending out your cash, the actual value of your money is constantly under attack. Inflation is the slow, invisible erosion of your purchasing power. Your $5 bill stays a $5 bill, but year after year it buys less gas and fewer groceries. This happens when people have too much money and they all want to buy the same things. If 2,000 people want a TV, but a business only has 1,000 in stock, the business raises the price. The same thing occurs when supply chains choke, making it more expensive to produce goods in the first place. Then there are the larger economic resets, recessions. Over a period of at least 6 months, the economy shrinks, companies cut costs and jobs vanish, and people hoard their money. Sometimes it's triggered by a global crisis, and sometimes it's just the natural cycle doing what it does best. Boom, peak, bust, and reset. When inflation spikes out of control, the government pulls a massive lever to force a cool down. They raise interest rates. Suddenly, getting a loan for a car or a house becomes painfully expensive. People stop borrowing, which means they stop spending, and the economy slows down. Between the rising prices of inflation and the constant threat of a recession, your finances are always facing friction. It means if you just leave your cash sitting in a shoebox or even a basic bank account, you are guaranteeing a quiet, steady loss of value over time. The central mechanic driving all of this, the loans, the banks, the inflation fighting, is interest. Very simply, interest is the rent charged for money to exist in someone else's hands. This graph illustrates the two ways that rent is calculated. Simple interest is a flat fee, a straight linear line. But compound interest operates differently. Every dollar you put in creates clones, and then those clones also start demanding rent. Given enough time, that growth curve goes vertical. The problem is that lenders use this exact math against you. If you owe 20% interest on a credit card and miss a payment, your interest starts earning interest. That steep upward curve inverses, plunging deep into the red, turning a $12 burrito into $50 of suffocating debt. It's a slow burn that turns small mistakes into financial fires, and it's a time bomb that turns small gains into massive wins. Compound interest is the silent engine running the world. Its impact relies entirely on whether you are paying the rent or collecting it. The only mathematical way to collect that rent and outpace the friction of inflation is investing. You buy tiny ownership slices of companies through stocks, or you loan money to governments through bonds, letting your money multiply instead of stagnating. This works because of how humans assign value. Look at gold. Physically, it's just a rock that happens to be shiny and yellow. It has no more practical use than an average stone. It is worth more simply because humans collectively place a higher subjective value on it. That same principle dictates modern wealth. Steve Jobs built an enormous fortune because he figured out how to create an electronic device millions of people perceived as highly valuable. If you provide immense value, even if it's purely perceived value like a luxury handbag, people will willingly hand you thousands of dollars for it. The goal of scaling value and reinvesting is escape velocity, detaching your income from your physical labor. Investing comes with risk. Markets go up and down, but refusing to play the game is far more dangerous. If you learn the rules, you stop trading hours for dollars. You turn your money into an unpaid employee, and you finally buy back the only truly finite asset you possess, your time.